What's up guys, welcome back to InvestingPH. Today I'll be showing you guys my magic formula when I compute my buy below price for the companies I invest in. But before that, you should click on the magic button for the YouTube algorithm. Yes, turn that button blue. And while you're at it, you might as well click on the subscribe button too. Now let's get started. First of all, I just want to tell you guys some horrible truth. There is no magic formula in investing. Wait, let me explain first. This is not a clickbait video. I'll still show you my formula for my buy below price. I just want to clarify to you investors is that there is no one formula to predict the stock market. There is no one valuation that can make you a successful investor. Even with the best formula out there to compute for the intrinsic value, it won't be enough to valuate a company. This formula that I will be showing to you guys is just a projection, a smart speculation you can say, or a guide when you are going to be buying or not. Let's just say this gives your speculation about the company a much better sense, and it gives you a real value as well when to buy. If you have watched my stock analysis videos, I always put my buy below price at the end of my videos. Why? Because for me, the first thing you should check about a business is their fundamentals, their financials, their product, what you think their moat is, so on and so forth. You should research what you can about the company first before computing for your buy below price. All your research about the company will combine as one to make a deductive decision whether or not to invest in the company. That's how it's supposed to be. It's just like saying don't just rely on the PE ratio or the price to book value when valuing a company. Just like this one, don't just rely on your buy below price that you have computed. It's not enough to value a company. It will just be a guide for you. And the formula I'll be showing you is just one of the many formulas out there that computes the intrinsic value of a company. So again, never use this formula alone. You have to run through your checklist before computing your buy below price. It has to pass your valuation first. With that said, let's start. So this is my formula to compute for the future value of the stock. Now, to understand this formula, we get the EPS of the company, multiply it to its growth, in which I use the ROE for this, and project their earnings to 10 years, which is represented by the raised to the power of 10, and we multiply it to its PE ratio. Now, this is how we go on about the future value. We are assuming that the company's earning will grow at the rate of its ROE for the next 10 years to come up with the future value. To further understand this, let's put Globe as an example. So the data we need is quite easy to find. It's available in MSN Money and investing.com. So we need EPS, 5-year average of ROE, 5-year average of the PE ratio. You can get EPS from the summary in MSN or overview in investing.com. For Globe, it's 139.29. Now for the PE ratio and 5-year ROE average, we can get those in MSN Money under the analysis section. So for the PE ratio, you just click on the price ratios and get the 5-year high and the 5-year low, which is 17.43 and 12.48. Later, we will average this too. And for the 5-year average ROE, it's under management effectiveness. So for Globe, its ROE is really high. Now, this is up to you if you want to use this. If you think about it, 25% ROE is hard to maintain throughout the years, especially for a large company. Can we really assume that Globe will still grow 25% for the next 10 years? So for this, I kinda use my own judgment. So if I see companies with super high ROE, I usually use 15% as my baseline just to be conservative. Now some of you may question why I use ROE as my number for the growth of the company. Well, I see some use return on invested capital. You can also use that for your own valuation. Or if you don't like using both of them, you can use their annual average growth in their financial statements, like in the net income or equity, and even free cash flows growth. It's really up to you how you're going to visualize how this company is going to grow for the next 10 years. So now that we have all the data, I typed it up in Excel. I use Excel for me to compute it faster. And I could just save the layout so when I compute for other companies as well, it's already there for me. I just need to type in the different data. So this is my template wherein all the formulas are already typed in. As you can see, I have 3 formulas here. The first one is the one I showed you a while ago, computing for the future value. and the second is the intrinsic value. And the buy price is my buy below price, wherein I put my margin of safety. So for you to understand this, let's create a new Excel file for you guys. So just type in the needed values. So I type in the names for each line to make this tutorial a bit faster. Now you can pause this video to type in the datas. First of all, average your high and low PE ratio. Just select the two and click average. With that, let's go to the future value. So just follow this. Equals, then click on the EPS, then multiply sign, and 2 parentheses. Type in 1 plus symbol, and click on the ROE percentage. Then close parenthesis. Raise to the power of 10, close parenthesis again, and multiply by the PE ratio. With that, we get 8,427. So this is what we assume Globe's price will be in 10 years if it continues growing at a rate of 15%. Now for the intrinsic value, we type in the formula, so equals sign, then click future value, divided by parenthesis, 1.10, close parenthesis, raised to the power of 10. We get 3,249. So this is Globe's intrinsic value as of today. Now the 1.10 in the formula is our required rate of return. With this, if we bought Globe at 3,249, then we can assume to get 10% return annually for the next 10 years if its price rise up to 8,427. So you can tweak this number up. I want a minimum 10% return for my investment, so I use 1.10. But if you want a higher rate of return of 15%, then you type in 1.15. It's up to you. With a higher rate of return, you will get a much lower intrinsic value and a much lower buy below price later on. Now with this, we can compute for our buy below price. So this is the most simple. You just type equals sign again, then click the fair value and multiply to 50%. With this, you are buying Globe for half its intrinsic value, which is 1,624. So you have a margin of safety of 50%. But if 50% margin of safety is too big for you, then you go for 30%. This is what I usually use. With that, you just type in 70%. So you're buying the intrinsic value for 70% of its price. You get it? You just minus 30% margin of safety from 100%. Simple math. So with 70%, we got a buy below price of 2,274.34. This is with a 30% margin of safety. Now again, this is all up to you. You just tweak on your margin of safety to your comfortable number. So for me, I usually put 30% margin of safety. My lowest is 20%. But if I think the company I'm investing in is kinda risky, I really put 30% above as margin of safety for myself. So with that, I think that's it. Though there are still a lot of formulas I use like discounted cash flow, 10 cap rule of Philtown, and other stuff as well. I use other valuation method if I think I'm not sure of the first valuation I use, which is the formula I showed you. But more or less, this is the formula I use often because this is the most easiest way to do. Again, this is not some magic formula, okay? This is just a guide for you, or you can say an addition when you are valuing a stock. You still have to go through all your checklists. Don't just rely on a mere formula. So I think that's about it for this video. I hope you like the content of this video, guys. Again, do comment down below if you have any questions or suggestions for me. Thank you and see you in my next videos.